While growth stocks have outperformed value stocks year to date, there's ample reason to believe the leadership value exhibited in 2022 and 2021 will continue into the latter parts of this year. One indicator is the extreme concentration of total growth performance in just a handful of stocks. We believe persistent inflation and interest rates rising across the curve will give value a lot of room to run in 2023. Let's take a closer look. We started 2023 with somewhat spring-loaded markets. In 2022, while the S&P index fell 18%, value stocks outpaced growth stocks by 21%. With the Federal Reserve's policy rate up 425 basis points, the most rapid increase in history, the prices of interest rate-sensitive securities, such as growth stocks, had become severely depressed. However, we entered January with a bit of euphoria. Inflation started to slow with the Federal Reserve's aggressive efforts, and based on futures markets, investors were even expecting rate cuts by the end of 2023. This euphoria ignited a rally in higher-risk growth stocks, which outpaced value by 5% going into the mid-March banking crisis. Since the collapse of Silicon Valley Bank on March 10th, the 10-year Treasury yield has fallen about 75 basis points. While this should be positive for growth stocks in general, growth performance has been relatively chunky. Apple, Nvidia, Microsoft, Tesla, and Meta, some of the most depressed stocks of 2022, are all up more than 20% year to date, and together constitute the bulk of the return of the S&P 500 benchmark. If this is a growth rally, participation is narrow. On a sector level, it's even more extreme. Year to date, only two sectors, technology and communication services, have outpaced the S&P, with most sectors flat to down for the year. Most importantly, the spring-loaded reaction of a few stocks doesn't mean a growth rally will persist. The market sees a 50% probability of an additional rate hike in May, and we believe the 10-year Treasury yield may be lower than what fundamentals suggest it should be. We expect higher rates will persist the remainder of the year as we expect inflation will not decrease as fast as the market anticipates. We feel rising interest rates, high inflation, and fresh memories of banking crisis will make the continuation of a high volatility growth rally unlikely.